Hi guys, welcome to our next topic. This topic covers 2 weeks. It's a fairly large topic, so there'll be some questions for week 9, and there'll also be some questions for you for week 10 in the LMS. So we'll get started. So I'm just going to share my screen, and then we can get started, okay? All right, so in this topic, we are looking at what we call financial management strategies, okay? Financial management strategies. So let's get on. As I said, weeks 9 and 10, and let's talk about it. All right, so one of the first things we need to talk about is the fact that there's a difference between profit and cash. So profit is equal to revenue minus expenses, but it also includes non-cash items such as depreciation. It also accounts for revenue and expenses on an accrual basis. So we recognize revenue when it's earned, and we recognize expenses when they've been paid, not necessarily when the cash has been received and paid. Cash accounting, on the other hand, is all about how much cash has come in, that would be revenue, and how much cash has gone out, and that would be usually expenses, okay? So that's a really important concept because a lot of businesses get that mixed up and they kind of see them as one and the same thing. No, you could have really poor cash flow, but you have a high profit. And why do you have poor cash flow? Because you're not collecting the money owing to you. You have a high profit, and then the ATO comes along and wants you to pay tax, but you haven't got any cash to pay it, and you've got to take out a loan. So you've got to be really careful with that, okay? Now, with that in mind, one of the first topic we need to talk about is working capital, okay? Working capital is a business investment in short-term assets, including cash, short-term securities, including things like accounts receivable and inventory in excess of accounts payable and short-term commitments. So when we talk about current assets minus current liabilities, we're normally talking about net working capital. Now, there's a need for businesses to hold cash, okay? And there's several motives behind it, okay? One of these could be a transaction motive, i.e. we need to buy and sell things, so we need cash to be able to buy and sell things. There's a precautionary motive. It's kind of like keeping money aside for a rainy day, okay? It's kind of like keeping money aside for a rainy day. And there's speculative motive, i.e. there might be opportunities that come along for which we need cash, a reduced price on inventory that requires cash payment, or maybe even to purchase a competitor at a reduced price because they're in an insolvent position, but we need cash to be able to do that. Now, when we talk about working capital, one of the things we often have to be careful about is our level of working capital favorable or unfavorable? And it says here actual cost. So it's the actual amounts when we compare it to budgeted amounts. Not a big deal. We've kind of talked about that in the past. But there's a number of strategies to manage our working capital. Now, one of the problems with working capital, we don't want too much cash and liquid assets on hand, but we don't want too little. So if you have too much cash, cash doesn't earn you much of a return. And if you have too much in the way of things like inventory, you have the problem that inventory can become obsolete. You have to pay to store it. You might have to pay insurance on it. You might have to build a bigger facility. But like I said, if you don't have enough, You may not be able to meet customer demands. If it's raw materials, you may have to stop production. So a business can employ a range of strategies to help maximize its working capital position. These strategies revolve around the business holding on to cash for the greatest amount of time so that the value of the organization is maximized. Okay, so examples of working capital management could be negotiating trading terms with creditors so that payment for goods or services can be deferred as long as possible. Okay, we might want to collect the money owing to us in the shortest time possible. So that might be offering payment options such as BPay or credit card, direct debit, get paid early rather than having that money owed to us on an account. If people aren't paying us, we might have to consider debt collection as a way of collecting money owing to us. So turning inventory over in the shortest possible time, i.e. not letting inventory sit around. Inventory in some businesses represents a large or a huge investment and ties up working capital, i.e. the cash could be used for something else. And the way we might manage that is to improve our ordering systems, or maybe just better inventory control systems or inventory control management. Finally, we might have accounts receivable. Okay, and we might sell those accounts receivable to a third party. So for every dollar of accounts receivable, we might sell it for 95 cents. So if we're owed $100,000 in accounts receivable, we might sell it for $95,000. And the person who buys it, they make money by making sure that they collect the full amount. So if they collect $99,000 worth and it was worth 95, they've made $4,000. You probably don't want to do that as a business because some of those collection agencies can be quite aggressive with your customers, okay? And that can damage your reputation. All right. So the following relates to Brisbane Bongos Limited. Projected net income, depreciation, amortization, etc. So their net income for the year is expected to be $20,000. Okay. Depreciation and amortization, $5,000. Capital expenditure, $25,000. An increase in net working capital is $2,000. So we're looking at the cash outflows effectively and cash inflows. Now we've got to keep in mind that the depreciation and the amortization are non-cash items, okay? So the question asks, calculate the free cash flow. So this is kind of a proxy for cash flow because while we've got net income, we're not assured that everything has been collected or paid in cash. There could be some accounts receivable or accounts payable. We do know that depreciation is a non-cash item. So we add that back, okay? We then deduct capital expenditure and then we deduct our increase in working capital. So that, because an increase in working capital would have to pay cash for inventory, that would be a cash outflow. Capital expenditure would be a cash outflow as well. And so that gives the free cash flow of $18 million in this case. So what are the consequences when it comes to working capital? Okay. If working capital is not controlled, then the organization stands to lose money. Each month's accounts receivable is not collected, it costs the business twice-fold, as funds lose their value over time and the opportunity cost of having the funds invested elsewhere. There's also costs associated with the collection, such as clerical costs, time, postage, making sure that people pay you what is owed to you, okay? So far, we've talked about a number of important concepts, okay? And I think we've just got to keep those in mind. So working capital, and the reason working capital is important is a lot of companies don't put enough focus on, when really they should be putting a lot of focus on working capital, okay? All right, so the next thing we need to talk about is, let me just go to my screen, sorry about that. The next thing we need to talk about is what we refer to as the time value of money. Okay, now this is a pretty important concept. Okay, so let me just fix that. It didn't seem to work, that share, I don't think, the first time. Let's do it the second time. So the time value of money, guys. Now, if you're like most people, you would choose to receive $10,000 now. After all, 3 years is a long wait if you were going to receive it in 3 years. And why would any rational person defer payment into the future when he or she could have the same amount of money now? So $1 today is worth $1 in 3 years' time. Okay. For most of us, taking the money in the present is just instinctive. So at the basic level, the time value of money demonstrates that all things being equal, it's better to have money now than money later. Why? Well, if I have a choice of $100 now or $100 in a year's time, that $100 now, I have it, I'm not waiting for it. So I know it's going to get paid to me. But don't forget, we lose spending power through inflation. And there's also the fact that I could invest that $100 and maybe at the end of the year, I might have 105. But why is this the case? Okay, so a $100 bill has the same value as a $100 bill 1 year from now, doesn't it? Well, actually, although the bill is the same, you can do more with the money if you have it now, because over time, you can earn more interest on your money. Okay, so back to our example. By receiving $10,000 today, you're poised to increase the future value of your money by investing and gaining interest over a period of time. Okay. For the alternative option, which is receive $10,000 in 3 years' time, you don't have time on your side. Okay. And the $10,000 in 3 years' time will be the future value. So what am I after? Am I better to have $10,000 now that I can earn interest on, or $10,000 in the future that I miss out on the interest? Well, of course, option A is a much better outcome. If you are choosing option A, your future value would be $10,000 plus any interest acquired. Whereas the future value for option B is just going to be $10,000. Well, what does this mean? How can we actually calculate how much option A is going to be worth? So let's have a look. We can see that the exponent is equal to the number of years for which the money is earning interest on an investment. So the calculation for calculating the 3-year future value is equal to the 10,000 multiplied by 1 plus the interest rate. In this case, it would be 4.5% to the power of 3, because we're trying to find out how much it's worth in 3 years. Okay, so what am I better off? Am I better to have $10,000 now? Of course, because in 3 years, if I invest that at 4.5%, my 10,000 is going to be worth over 11,400. Whereas if I took option B, I'm $1,411.66 worse off. Okay. So what the calculation shows is that we don't need to calculate the future value after the first year, then the second year, then the third year. If you know how many years you would like to hold a present amount of money in an investment, the future value is just simply the original amount multiplied by 1 plus the interest rate to the power of the number of periods. And this year, the number of periods was 3 years. So we put a 3 in there, and that's how we worked out our future value. Okay. Now, there is a nice little thing I want to talk about, and you can use it in business. You can use it at home. It's pretty amazing. On this side, we consider an approximate slide. We consider an approximate way of calculating how to double our money. But first of all, a question, okay? How long would it take to double $5,000 if you're earning 12% per year, okay? So how long would it take that $5,000 to end up being $10,000? Now, I don't even know the answer to this, but I know straight away it's about 6 years. How do I know that? Did I guess? No. What I did, I used what we call the rule of 72, okay? The rule of 72. So 72 divided by 12, okay, is 6%, is 6. What that means, it takes me about 6 years to double my money, okay? If my interest rate was 7.2%, 72 divided by 7.2, it'd take about 10 years to double my money. If the interest rate I was earning was 1%, it'd take about 72 years to double my money. And that's what this diagram here is showing, okay? So the rule of 72 is a simplified way to determine how long an investment will take to double, giving a constant or a fixed amount of interest. So if we divide 72 by the annual rate of return, investors can get a rough estimate of how many years it will take for the initial investment to double. Now, it's not a perfect solution, but it's a pretty good one. So if you are dealing with people and they're saying, yeah, we're looking to double our money, okay, so if I invest at 5%, how long would that take? Well, you could just have 72 divided by 5 and you'd say, oh, about 14 and a half years. And they would think you're the smartest person on the planet. Okay, so it's just a nice little rule. I think it's important, especially when you're dealing with people, can show that you know a lot about these things. Okay, so government funding, okay, it changes every year, okay. Back in the early 2000s, the total level of government funding from the 3 levels of sport was 2.2124 million, so $2 billion. And that funding came from Commonwealth, state, and local governments, okay? Now, this funding was, spending was about, most of it came from the government, a little bit of it came from business, okay? And where the funding was directed, a lot was directed towards sponsorship, okay? So that's just a little bit about that. It's not really as relevant because we do some kind of separate assignments on that. So one thing we do need to talk about is the fact that companies or governments or organizations have to raise capital. They have to raise money. One of the ways they can do this is by using debt. You gain money without giving over some ownership or control of your business because you're just borrowing it, say from a bank. Okay, you must pay back the principal, the amount you borrowed plus the interest, and that often creates a monthly drain on people's cash flow. Okay, if your interest payments are greater than your return on your investment, then your outflow is going to be greater than your inflow, and you'll soon run into financial difficulties here. Before a lender will loan you funds, it will require you to complete a business plan and other planning processes, okay? i.e., it will force a business to complete tasks that it may not otherwise do, okay? But you might get some free business advice from the bank at the same time, which could be a good thing. Doing that effort of working out what the funding is, what my business plan is. That can actually help your business in the long run, okay? In the long run. Equity, that's when a company issues shares. Investors give you money, but in return, you give them a proportion of your business. Your business benefits by receiving a cash injection, and the investors benefit in that they get to share in the business profits and sometimes in its management if they've got the ability to take over the company. You're effectively giving away part of the ownership and control of your business when you sell shares. Unlike debt, however, you have no legal or contractual obligation to pay back the money owed. So it's like an interest-free loan, but you are giving up ownership because you're selling ownership shares in the company, okay? Okay. So I want to go back to working capital for a second, guys. So cash flows in a cycle into, around, and out of the business. It's the business's lifeblood, okay? And the manager's primary task is to keep it flowing and to use the cash flow to generate profits. If a business is operating profitably, then it should, in theory, generate cash surpluses. If it doesn't generate a surplus, the business will eventually run out of cash. Now, the faster a business expands, the more cash it will need for working capital and investment. The cheapest and best source of cash exists as working capital right within the business. Good management of working capital will generate cash, okay, will help improve profits and reduce risks, okay? So what we're saying there is that when a business expands, it needs cash. What's the best way of generating that cash? Is generating it internally, not borrowing it, because there's a cost with that if you borrowed it from a bank, or not issuing shares because you lose ownership. It's generating it internally. So having more cash come in than goes out, okay? So there are two elements in the business cycle that absorb cash. Inventory, i.e. we have to purchase inventory, and we often purchase either raw materials or other materials like stock, and we have to wait till we collect that money, and that's in the form of receivables. But the main sources of cash are going to be payables, people paying you the money that you're owed, equity, and also loans, okay? And that gives us what we call the working capital cycle, okay? We purchase inventory, and until we sell that inventory and collect the receivables, we're waiting for cash. So purchasing the inventory, we'll often purchase it on credit, and after a period of time, we have to pay the payable. We can't let it go forever. So now we've paid for the inventory, but we haven't yet sold it. When we sell it, oops, didn't want to do that. When we sell it, we'll either receive it straight away in cash, or we'll have to wait even longer to receive the money that is owed to us, okay? So each component of working capital has two dimensions: the time and how much it's worth, the money. When it comes to managing working capital, time is money, okay? If you can get money to move fast around the cycle, i.e. collect money's due from the debtors more quickly, or reduce the amount tied up, i.e. reduce the inventory levels, the business will generate more cash, or it may need to borrow less to fund its working capital. If you've got more cash and you don't need to borrow from a bank, as a consequence, you could reduce the cost of bank interest, or you'll have extra cash available that you can use to support other parts of the business to grow. If you can negotiate improved terms with your suppliers, i.e. get a longer credit or an increased credit limit, by you not having to pay straight away, that's them actually loaning you money. And for a lot of organizations, they might give you 30 days to pay. That's like a 30-day interest-free loan, okay? So as far as this goes, this working capital, so if we collect receivables faster, we release cash from the cycle, it comes back to us. If we collect receivables slower, there's more money being soaked up and we're not generating or not turning it into cash. If you get better credit from suppliers, it means you don't have to pay as quickly or as much as quickly. You're going to increase your cash resources. If you can sell your inventory faster, you free up cash, okay? But if you have more inventory that's not been turned over, you consume more cash. A common method of raising short-term cash is what we call a bank overdraft. Sometimes we call them line of credit nowadays, okay? So basically what a bank overdraft does, and we still see them, they let you go into a negative amount on your bank account. So this form of finance allows the business to write checks, etc., or withdraw above the amount of money above the balance in its check account. So it basically means you can go into a negative amount, okay? But there is a limit and you can only go to a certain amount. This form of finance historically has been a major short-term finance, okay? The cost of an overdraft is interest charged on the amount overdrawn. Interest is also, however, charged on the amount of money that has not been used. So if you have a $10,000 overdraft limit, they might charge you 0.25% on that $10,000, regardless of whether you take the money out or not. But if you do use it and you're overdrawn by $3,000, that might create a 6% interest rate on that $3,000. So the charge is to compensate the bank for keeping the funds in reserve, just in case the business wants to use them. When the business deposits checks from payments or receives payments, it reduces the outstanding balance. Unlike other loans, there's no set repayment schedule, okay? And the amount of the loan also fluctuates as payments and receipts come in and go out. Now, it's actually quite useful, this particular thing, this overdraft, because you don't have to worry about, oh, what happens if I've written too many checks, will I have enough cash come in? You don't have to worry about that because the system handles it, okay? It's not like, oh no, I'm $10 overdrawn, I'm going to have a huge fee involved. No, it's not like that. Factoring is where a business sells its outstanding accounts receivable. As such, factoring is not a loan. The financial institution you've sold to collects the account. It receives the full amount, okay? So the difference between what it paid to the business and what it received by the debtors, from the debtors, is its return, okay? Okay. Due to the level of risk of bad and doubtful debts and the administrative cost for the finance companies offering this form of finance, okay, they often give you a lot lower. So if you had $100,000 worth of receivables, they might only give you $75,000 or $70,000. And so you miss out on that other amount. But having said that, you don't have to collect them, okay? It's expensive. You also find that some of these factoring firms can be very aggressive with your clients, and that can actually create a bad relationship with your clients as well, okay? And so you might actually lose customers if you start to factor, okay? You might actually lose customers. Now, let's keep going. Trade credit. This is the credit offered by the supplier of goods and services. Unlike other types of short-term debt, it does not involve the costs. When goods are delivered, an invoice is issued, and this states that payment is required in a number of days' time. It allows for a period of grace before the account has to be paid. An interest-free short-term loan is effectively what it is. Normally, a lot of companies would give you 30 days after the end of the month. So if the end of the month's the 30th of April, you've got another 30 days. So if you bought it from the 1st of April, you're going to get all of April plus the 30 days. The terms of the credit is expressed on an invoice. Now, something you sometimes see is it expressed this way, okay? 210 net 30, okay? So what that means, this indicates that payment is due in 30 days, or if payment is made within 10 days, a 2% discount will be given. Now, the mathematics behind this is you should always take the discount. Trade credit is an interest-free loan. It's based on trust, and generally before it's offered to a business, a credit check of the business past payment record will be investigated, i.e. to consider the term of the loan, how much credit they will give you. Normally when you build up a good reputation with a customer or a supplier, they might increase the amount of credit they give you as you show that you're a reliable payer, okay? All right, so that's reached the end of our group of slides today. This is a kind of an interesting topic because there's a lot in it. So what's happened, this has actually covered weeks 9 and 10. So there won't be a video next week because that's been covered this week. And then next week, or this week, we've got tutorial questions. And then next week, we'll also have tutorial questions that I've put in the that I've put online for you, okay? As always, if you've got any questions, please keep in contact with me. And other than that, have a great day, keep studying hard, and I will talk to you next time we speak. Thanks very much. Have a great day.